needle on the record.
Welcome to Wage Cucking with JMO.
All right, guys, welcome to yet another episode of Wage Cucking with JMO. Today we have a guest, Tascha, from INIT Capital. Tascha, how you doing?
Good. Thanks for having me.
No problems. Before we get started talking about INIT, you want to give me a little, a brief synopsis of your background in crypto, how you got in and what you've worked on before?
Yeah, sure. So I started trading since early 2017, but actually started building in 2020, which is like when DeFi was actually getting started. So I would say, so we started out as Alpha Finance. That's the first project that I built, and then over Alpha Finance years, we built multiple DeFi products. So been dabbling in DeFi for quite some time. And then in 2023, we rebranded from Alpha Finance to Stella. And then late 2023 as well, transitioned to advisory role at Stella. And then, started INIT, which is a separate project, but should be synergistic with a lot of the other DeFi protocols in the space, including Stella as well. That's a long story short.
Yeah, I remember actually using Alpha back in 2020 was DeFi summer, where there was like a ton of DeFi protocols popping up, a lot of like yield farming. It was one of the first protocols that allowed for leveraged yield farming, which I thought of a pretty interesting concept. Basically, it allowed people, if they were willing to take risks, to deposit only like a limited amount of capital and leverage it up. So, I mean, if there were reasonable DeFi farming opportunities and someone was limited in capital, they could scale up their operation pretty greatly. So let's talk a little bit about INIT. So I guess let's start off by talking about the whole DeFi landscape right now. What are the issues you think we have today that you're trying to solve with your new protocol?
Yeah, so I think if you look at, DeFi nowadays, there's so many segments and bits and pieces. A lot of the segments are actually new, like, you trading, restaking, etc., right? And then the big problem that we come across is pretty much that a lot of these protocols in these segments, including perps, options as well, they actually have a hard time tapping into the available liquidity in existing money market. And actually what they have to do is they have to bootstrap and source their own liquidity, right? Because all these DeFi protocols would need to have an initial liquidity or even continuously to source liquidity. And then there's a huge gap between demand and supply because you have this demand from all these, DeFi protocols wanting to borrow liquidity or tap into the available liquidity. And then you have the existing money markets that actually cannot offer that liquidity to these protocols, right? So when you see that demand and supply gap, then it questions you like, okay, like why is that the case? And I think mainly because the existing money markets nowadays are actually built, in the design of like 2019, 2020, which is okay, but it focuses a lot more on the use case in 2019, 2020, which none of these use cases actually like were there in those years, right? Like the only thing that you could do in those years were like to borrow to long and short tokens, and you cannot do all these different activities in DeFi now. So I think that's like the main idea is that how can we create, a lot more composable money markets such that it would serve, more demands of DeFi nowadays and also in the future, right? So that's the main idea of the problem. And we solve that problem with the concept of liquidity hook. So you can think of INIT Capital as a liquidity hook money market, right? Which we got inspiration from Uniswap V4 hook, which is like with Uniswap V4, you can do things before and after swapping. Different protocols can build and have the composability. So we're just like, hey, like, what if we adapt that concept and apply to money market, which is very important to what do you do before and after borrowing, right? Because the key is like, how do you earn higher yields from the borrowed capital? Like otherwise, why would you use money market to begin with? So that gave rise to the whole concept of liquidity hooks. And yeah, I can talk more about what those are.
Yeah, it feels like a lot of the older money markets that were developed, let's say like 2019, 2020, they're a little bit outdated because they were developed in a time where basically all you can do on chain was trade using automated market makers, right? Like there wasn't really like this whole slew of DeFi options. Like now we have like a ton of perp dexes. You can trade options. You can trade synthetic assets. You can there's this whole move towards like interchain or cross chain borrowing, lending, trading, settlement, stuff like that. And like the infrastructure that was developed in say like Aave or Compound or like Curve or Maker seems to have not really like improved enough to capture that market. It's interesting you bring up Uniswap the V4 hooks because I felt like when that came out, that was like a pretty interesting idea. Like the examples they used, if I remember correctly, they would have like internal MEV or like auto compound LP, or you could do stuff like put in like time weighted orders, price weighted orders, limit orders, and stuff like that. I don't know how much those are really being used today. But again, like this is like only on Uniswap and only on Ethereum, and I don't think they really integrate other money markets aren't really integrating that well with them to allow for like liquidity to be capital efficient and not like scattered everywhere and difficult to use. So yeah, I guess moving forward, to talk a little bit about in it specifically, your plans for the future, especially I guess like what kind of hooks and what kind of protocols do you see integrating into in it?
Yeah. So there are actually like different kinds of liquidity hooks, but the majority of them that are being developed now are to integrate to borrow liquidity from init and execute different use strategies afterwards, right? So one example is looping of LST. I think that is like quite free yields, especially when there are like inherent higher lending APY from the staking yields. So different protocols are building, mETH or mETH vaults to do like 5x looping, and etc. Right? Different protocols have different strategies, and they also have different incentives on top of like the LST yields already. The second type that are being built now as well by different protocols is margin trading. So with margin trading, it's also very easy to borrow liquidity from init and enable end users to have leverage because we have this tech that we call flash borrow. So it makes it makes the integrator's job a lot easier without having to use flash swap and without having to like write different logics in between. So we just simplify a lot of the work that they have to do and just call one function, which is flash borrow. So that's the second type. A few protocols reached out to also build leverage LP liquidity hooks. So those would be, I think, upcoming. And then there are different angles with perp dexes that we're also exploring to see like which kind of liquidity hook would be best. Yeah, but ultimately, I think ultimately if you want to borrow liquidity to enable leverage, that would be, one way to work within it. Or if you don't need to have leverage, that would also be another angle of liquidity hooks. Or if you are like a lending vaults and then just depositing to init to ARP different rates and build vaults on top of init, that would also be another angle of liquidity hooks as well.
Mm-hmm. Yeah, it sounds like it's going to be like a pretty open platform where like I guess that there are some future use cases, but I feel like there might be some use cases that we really haven't even thought of, and new protocols will come out with like different designs and stuff like that, and they'll be able to use this hook concept. So for the listeners or watchers who didn't understand the first part about the leveraged mETH or meth. Basically, the strategy there is because it's staked on Beacon Chain and it gets rewards, and there's going to be like some sort of like eigenlayer restaking. If you have like a limited amount of capital, and you want to leverage your position. Essentially, what you're doing is depositing the yield-bearing asset as collateral, borrowing the standard ETH, or in this case, because it's on an L2, it would be wrapped Ethereum, and then converting that wrapped Ethereum to the mantle Ethereum. So essentially, let's say you deposit like 10 Ethereum, you could probably borrow against it, like safely borrow 7-8 Ethereum, deposit that on staking, and suddenly your position is like 70% larger. And it I think it introduces a pretty interesting concept of looping. But basically, if you're always adding the value of your borrows to your collateral, it essentially allows you to borrow a lot more than like what your collateral is, your initial collateral is. So I believe that I've played around a little bit with the platform. I believe that isn't enabled yet. I mean, I think it's enabled in a way where you can borrow Ethereum, but I don't think Mantle Ethereum is one of the borrowable assets. Yeah, so to talk a little bit about the roadmap, are you looking to introduce new assets for borrowing and lending? Are there any features that are coming out soon, stuff like that?
Yeah. So a few liquidity hooks are coming live in February, actually. So as mentioned just now, mETH one-click looping. So you can go up to like 5x leverage, which means that it automatically like does everything for you. Let's say you provide 10 mETH, and then you go like 5x, it would automatically borrow, 4 ETH for you, or wrap ETH, and then do everything such that you get the yields of like 5x of your one in mETH, right? So that's coming live. And then margin trading is also coming live on different dexes, because different integrating protocols are building on different like underlying dex providers. And then at the same time, we're also exploring on the USDY as well to be accepted as collateral. We're still evaluating on the risk parameters, but it's on the roadmap that we're looking to support. And then definitely like STETH as well. They have finally added liquidity to Mantle, and I think they're also going to ramp up more liquidity. So as they ramp up more liquidity on different exchanges on the dexes, then we can enable that as collateral. Yeah. So those are the quick roadmap. Yeah.
Yeah. So like when you look at stuff like adding new assets and judging risks, are you mainly just looking at like the on-chain liquidity and stuff like that in case of liquidations? Like this is sometimes when you have these borrow lend platforms and like a token or an asset is not fully liquid. A lot of protocols in the past have encountered a decent amount of bad debt where they have like especially large positions, and the collateral weight, I guess, is determined by an oracle price, but not really considering like the on-chain liquidity for that asset. So at the point where a liquidation event does happen, if the on-chain liquidity, especially if it's on something like a layer 2 or something where like the markets are a bit isolated, and you don't have access to like centralized exchanges, you don't have access to like the global DEX volume. A lot of the times these protocols will encounter like a decent size bad debt positions, which kind of it sort of makes like the protocols defunct, just because like if you have like a huge position that is like underwater and you can't liquidate it, it means that like all the participants in this market specifically are going to have issues with their collaterals and their borrows as well. So yeah, you just talk about that process about like how you figure out what assets to include, how do you limit the risk for both the borrowers and the lenders.
Yeah, sure. So I think there are several things that we take a look at. Number one is for sure like Oracle supporting, because without Oracle supporting, then a lot of risk would be on us ourselves, right? And then second is the liquidity on chain is also something that we set as a parameter and link with how much in total can everyone in the platform borrow. So we call it borrow cap. because in the end, like, and as you were mentioning, like if incident happens and all the borrowings have to be liquidated in one time, perhaps a black swan event, hopefully not. But if that were to happen, we need to ensure that all of the borrowings would be able to be liquidated, right? Which hence, be linked to the on-chain liquidity. Yeah, so there's a cap of like how much in total can everyone borrow on the platform to enable liquidations to be able to happen in time. And then third is also, we always take a look at volatility of the assets. And these volatilities of the assets actually determine, collateral factor, borrow factor, liquidations premium. So all these parameters that I like throw out there, like they all link to enable, to make sure that, collateral will always be more than borrow based on the collateral factor, based on the borrow factor and liquidation premium that we set. And ultimately, like as a money market, we need to make sure that liquidations can happen in time when they need to. Yeah.
Yeah, that makes sense. Like so for example, if you have like a high market cap stable coin, you probably have like a higher collateral factor. Like with a certain amount of collateral, you can borrow more assets. But then, if you start integrating like lower market cap coins that may and not only are less liquid, but their asset value may fluctuate very quickly. Obviously, that adds a bit more risk to the protocol. Therefore, like you have to add more risk parameters in order to protect the protocol from bad debt.
Yeah, correct. Yeah.
Yeah, I think the going back a bit to I believe you said is coming out soon, the auto looping. I always like that feature on these money markets just because it's quite tiresome sometimes if you want to pull out positions like this where you're looping to basically have to make like tens or hundreds of transactions sometimes, depending on like what assets and how often you want to loop it. Basically, like each individual transaction would be like a deposit and then a borrow, then a deposit again. So each loop would be two transactions, and then that's not including like the approvals and what else you have to do. So yeah, it's a pretty good feature that allows the user to basically just like click one button and then like suddenly their position is finished rather than constantly tweaking and adding and changing their position just to create the right parameters. Whereas like sometimes like in previous protocols where they incentivize both sides of the borrow and lend, and you would have to manually do the looping thing. Sometimes I would mathematically calculate like my collateral and then my deposits incorrectly, and then like either over borrow or under borrow, and like forget like I had this position that I wanted it to be like looped like 5 times, but it only got looped twice and stuff like that. So I think that that's a pretty good feature, and one that will make the end user very happy. Yeah, so I guess let's talk a little bit about how individuals that are like listening or watching this podcast are able to participate. I know you guys are running a points program right now, and there's also mantle incentives for, I believe, the borrow side. You want to talk a little bit about that?
Yeah. So we launched the app roughly like 2 weeks ago. And right now there's about in total like $50 million dollars market size. So a lot of people have been joining us in the launch, which is great. And yeah, anyone who hasn't joined us or used the app, feel free to start using, because we also have point system for lending and also for borrowing. If you also borrow, you would also, in addition to the INIT points, you would also get the MNT incentives, which means that it helps lower the borrow cost. MNT is the mantle governance token. So, those are the things that you can do with the app itself. But on the social side, you can also join INIT Capital Twitter, join our Discord. There are different campaigns and community events ongoing, which with these social activities, you can also earn different ways of INIT points as well. So yeah, if you don't have capital, if you don't have any capital on INIT, you can also get points by participating on the social side.
Hmm. Yeah, I believe it's 1 point for deposited assets per dollar, or I think it's time weighted, and then it's 7 points per dollar on the borrow side, and
$100.
then
Yeah.
oh for $100, and then
Yeah. So one
it's
point on the
time weighted,
lending.
correct?
Yeah, yeah. Time weighted and also position and size weighted. So with
Uh huh.
$1 with $100 per 24 hours, you would get 1 point, and then
Hmm.
$100 of borrowing per 24 hours, you would get 7 points. And then
I
MNT
see. I see.
incentives for the borrowing as well.
Uh-huh. So I guess for those listeners or watchers who don't know, a points program, I think they're pretty popular these days among newer protocols, or protocols that will eventually launch their token. Is basically, if you're an early user, you're an early adopter to a protocol, and you use it consistently before their token launch. It's essentially a way to reward like the early users when the token eventually does come out. So I don't know if you have a timeline set for that, but do you have any idea exactly when the token release would be, and like I guess the use case, or how the token would function with a relation to the platform?
Yeah, yeah. Exact time would be TBD. But roughly looking around, mid of this year timeline. In terms of the token utility, we're actually, exploring quite a lot of different interesting ideas, because ultimately, if you think about init, right? Init is more of a backbone for different DeFi protocols, because they can enable different liquidity hooks to build on top, right? So, very interesting angle is we can also enable different liquidity hooks to bond and direct incentives. That's one idea. Or to enable different lending assets to determine like how much of the lending liquidity would go to each different liquidity hook. That's also another idea, right? So I think there are multiple like angles you can include tokenomics to be driving growth for product, which I think is very crucial, and the tokenomics design that we're aiming for. So the token should be a governance token that also be able to help drive growth and also drive different incentives to the right stakeholders.
Mm-hmm. I see. I see. So it's a little bit similar to like the curve or convex model, right? Where you have like multiple different markets, and then if you have like a certain number of token holders that want incentives to be run on like one liquidity market, or one money market, they'll have some sort of vote or some sort of governance to allow like rewards, or like a return to be allocated to this market above all else. So like, as long as the protocol overall has value, or governance in the protocol overall has value, like the tokens will have value in some way.
Yeah, yeah. So that's one of the key theme, and then we also have like different new ideas that we're looking to introduce, but we'll keep it you know private for now. But there should be like a lot of revenue stream or different fee capturing streams that we're
Hmm.
looking to enable.
Uh-huh. I wanted to go back a little bit, talk about the specific hooks. Potentially, I remember reading through some of the documents, and a few of them like interest me like a bit. One of them was the multi-silo position. I assume that's for let's say like a perp market, or for margin trading. Essentially, like you can borrow like multiple assets. um, I guess you would do it in one go. You'd borrow multiple assets and use them for collateral. But if like for example, if you borrow like USD, and then you borrow Ethereum, if the ETH price fluctuates to a point where like your position in one trade might get liquidated, but like the USD value holds the same, it sort of isolates that position. Is that what you're envisioning when setting this up?
Yeah, yeah. So I think in order to enable different liquidity hooks to be able to build on top, we need to make sure there's a way to segregate the the risk, or also like segregate the impact of each, right? Because in the end, like we cannot, we don't want to have a wall garden of like, hey, only these types of liquidity hooks can only be built on init. But in order to enable that permissionless environment, like we flip the question in which, okay, how do we make sure that on the protocol level everything is already siloed, right? So that it enables the integrator to work a lot easier as well without having to comply to all these requirements on our end, right? So that's the the rationale for how we came up with multi-silo positions. And you can think of this as like each position, whether it's just a normal borrowing position, or maybe it's mETH looping, or can be like different margin trading, or etc. Right? It would means that each positions is very separate from the other. So if let's say ETH and mETH depegs a little bit, which trigger your 5x mETH looping positions to be liquidated. Like it will only, hurt that position. It would only liquidate that position, but it won't, mess up with any of your other positions. So I think that's a better design to enable like different liquidity hooks to be built on top.
Mm-hmm. Yeah, that definitely makes sense. The other thing I thought was pretty interesting was it sounds like you're looking to use like automated market maker LP as collateral. I assume the way it is work is like, and if I was an end user, I could deposit LP into a automated market maker, like some of the other ones on Mantle, like Merchant Mo or Agni, or I know that there are a few others, but essentially, I'd be depositing LP, meaning I'd be like, for example, if there's a market that's like ETH mETH or ETH USD. I would be depositing both of those assets in a pool where the traders within that market would be using my assets as liquidity to trade back and forth. And then in general, what happens is the automated market maker or the protocol itself would give you an LP token, basically a token that indicates you own a percentage or you own a share of this pool. So on your end, as far as I understand it, you're going to be integrating those LP tokens as liquidity for collateral. So like instead of just depositing, let's say Ethereum or Mantle Ethereum, I could deposit like Ethereum USD LP, and then that has value because it's liquidity in a pool. So not only can I borrow from that, but also like the LP in theory is yield generating, right? Because like as long as people are trading on the DEX and paying fees on the DEX, I'll get a portion of the trade fees, but without tying up my capital in like an automated market maker. Is that the general idea of what you're looking to do?
Yeah, correct. Pretty much like to enable more capital efficiency. But at the same time, this would also enable different kind of liquidity hooks as well, because some protocols build leverage LP functionalities, right? And as we speak, a protocol actually is building leverage LP liquidity hook as well, which means that you don't even have to have LP to begin with, or you don't have to have that DEX LP and then come to use init. You can, in one go, in a few clicks, be able to use that leverage LP liquidity hook, decide that you are providing some portion of ETH, some portion of USDC, for instance, and you go 5x on that, providing this liquidity, right? And then this leverage LP liquidity hook would do everything for you. Usually, a lot of times, the underlying AMM or DEX that you provide liquidity to, they would have different incentives to the liquidity providers as well. So you're getting those incentives and also like the trading fees that you would normally get. Yeah. So ultimately, like,
so
yeah.
Yeah, so like if a new DEX comes out and they're running like a points program or something, or that they have a native emissions token that incentivizes LPs, you essentially can use a hook in order to, let's say, deposit like to $10,000 of liquidity use the INIT market, money market, to leverage it to, like, say, $50,000 worth of liquidity, and, like, all in one go, be able to provide this liquidity to the DEX without having to, deposit your assets, borrow, deposit again, borrow, and then finally, when you have all your assets together, put it on the DEX. The entire process is sort of contained in one, maybe not one transaction, but like to the end user, maybe just like one or two clicks.
Yeah, correct.
All right. The last thing I wanted to talk about is we talked about basically how people that are like users of DeFi or users of these platforms can participate. I'm going to talk a little bit about like the protocol operators or different protocols. Like, for example, if I run a perpetuals protocol, or if I run a DEX, and I wanted to integrate some sort of liquidity hook, sourcing the INIT liquidity, or basically any interaction with INIT, how would I go about doing this?
Yeah. So please reach out to us. We're active on Discord, Twitter, or you can also just DM me as well. My first name _ PAN. Yeah. So I guess a lot of times we get a lot of inbounds from different protocols, and a lot of the benefits make sense for the integrating protocols. We also might be launching like different incentive program for the integrating protocols in the future as well. So, be sure to be early, to get those incentives.
Yeah, that sounds good. Yeah, we'll when the episode comes out, we'll put the we'll put the link to everything. Yeah, so for I guess either the protocol owners or developers, or like just users of DeFi, how would they basically how would they figure out like what updates, what points programs, like what new innovations are coming from INIT? Is there a Discord? I assume there's a Twitter that they can follow you directly as well.
Yeah. So we always update a lot of things on Twitter, and if you have any questions or like want any special treatment, feel free to join our Discord. We're pretty active there.
And then the Twitter is just INIT Capital, right?
Yeah, correct.
And then the link to the Discord is, I assume, like on the site or on the Twitter itself.
Yeah, on the Twitter. Yeah.
All right. That sounds good. I think that's all we have for today. Do you have anything else to add?
No, I think that's it. I think, if one last thing would probably be, we have quite a packed roadmap and a lot of exciting things coming. So if you're listening to this episode now, it means you're early, which is great. So don't forget to join.
Always good to be early.
For more things in the future.
All right, sounds good. I appreciate your time.
Okay, thanks so much.